In the months and years ahead, few forces could reshape the global economy as profoundly as the carry trade. This isn't just a strategy for currency traders, it's a mechanism that can redirect capital flows, destabilize markets, and influence the decisions of central banks worldwide. When interest rate gaps widen, the ripple effects can alter investment, debt, and even political stability. Stay with me, because understanding the carry trade now could mean seeing the future before it unfolds. The roots of this global financial strategy lie in Japan, which has long been the epicenter of the carry trade. At its core, the trade works like this. Investors borrow in a country where interest rates are extremely low, convert that money into another currency, and then invest in assets offering higher returns. For decades, Japan's near zero, and sometimes negative, interest rates made the yen the cheapest money to borrow anywhere in the world. Investors would borrow yen, convert it into US dollars, euros, or other currencies, and invest in higher-yielding bonds, stocks, or real estate. The difference between the very low cost of borrowing in Japan and the higher returns abroad created a profitable opportunity. This strategy relied on two main assumptions. First, that Japanese borrowing costs would remain extremely low, and second, that the yen would remain fairly stable relative to other currencies. The Bank of Japan, or BOJ, Japan's central bank responsible for managing interest rates and controlling government bond purchases, helped make this possible. Through policies like negative interest rates and yield curve control, the BOJ suppressed long-term bond yields and kept borrowing cheap for decades. The Japanese carry trade fueled global liquidity, meaning there was a lot of money available for borrowing and investment around the world. It allowed investors to take on more risk because they could finance their investments cheaply. Emerging market bonds, corporate debt, and even leveraged stock positions benefited from this flow of cheap Japanese funding. While the trade was largely invisible to the general public, it quietly underpinned a significant portion of international finance. But the environment that made the carry trade so profitable is now changing. In 2025, Japanese government bond yields, the interest investors earn for lending money to the government, have risen sharply, especially for long-term bonds that mature in 20, 30, or 40 years. When bond yields rise, the cost of borrowing also rises, which reduces the incentive to take on yen-denominated debt for investment abroad. The BOJ has ended its strict yield curve control, meaning it no longer keeps long-term interest rates artificially low, and it has started raising short-term interest rates to address rising inflation in Japan. This shift makes borrowing in yen more expensive and changes the math behind the carry trade. As borrowing costs climb, many investors find that their previously profitable positions are no longer worth the risk. When profitability falls, investors may choose to unwind their positions. This means they repay yen-denominated loans, sell foreign investments, and convert the money back into yen. While this is a natural adjustment, if many investors act at the same time, it can create ripple effects in global markets. One immediate consequence of unwinding is that the yen can strengthen. As investors buy yen to repay loans, demand for the currency rises, pushing up its value relative to other currencies. A stronger yen can reduce the value of foreign investments when converted back into yen, potentially causing losses for those who borrowed and invested heavily. Global risk assets may also be affected. Emerging market bonds, high-yield corporate debt, and other investments that benefited from cheap Japanese funding may experience price declines as liquidity dries up. Liquidity is the ease with which assets can be bought or sold. When it tightens, it becomes harder to buy or sell without affecting prices, which increases volatility in markets. Even traditionally safe investments may see fluctuations as the unwinding spreads across different markets. Japan itself faces multiple challenges from these changes. Higher domestic interest rates make loans and mortgages more expensive for households and businesses. Exporters could struggle because a stronger yen makes Japanese goods more costly overseas. Rising yields on government bonds increase the cost of Japan's already high public debt. Financial institutions like banks and pension funds, which hold large amounts of Japanese government bonds, may face losses if bond prices drop. This can affect their ability to lend money, further impacting the economy. The BOJ now faces a delicate balance. It needs to normalize rates to manage inflation, but raising yields too quickly could destabilize markets and slow economic growth. Attempting to suppress yields again through large-scale bond purchases could reignite inflation and distort market pricing. Investors and policymakers are navigating a narrow path where missteps can have broad consequences. The unwind of the Japanese carry trade also has global implications. Cheap Japanese funding has historically supported investments worldwide. As borrowing costs rise and the carry trade diminishes, capital may flow back into Japan. This can increase volatility in currencies, tighten global credit, and create uncertainty in markets that once benefited from low-cost funding. Emerging market economies, which often relied on access to cheap capital, may face tighter financial conditions, currency pressures, and higher borrowing costs. Even for individuals who do not invest internationally, these changes can matter. Higher global borrowing costs may translate into more expensive loans, mortgages, and credit at home. Volatility in global markets can indirectly affect retirement funds, savings, and investments. Changes in currency values may influence import and export prices, potentially affecting inflation and everyday costs. Looking ahead, there are several possible ways the Japanese carry trade unwind could unfold, each with different consequences for markets, investors, and the economy. In a gradual normalization scenario, the Bank of Japan continues to raise interest rates slowly, allowing bond yields to stabilize. Investors unwind their positions methodically over months or even years, which gives markets time to adjust. Capital repatriation, the process of bringing money back to Japan, happens in stages rather than all at once. The yen strengthens moderately, global markets reprice gradually, and emerging market economies adjust without crises. In this scenario, the era of cheap Japanese funding ends, but markets remain stable and systemic risks are contained. In a more disorderly scenario, rising yields and a stronger yen could trigger rapid, large-scale unwinding. Investors may be forced to repay yen-denominated loans quickly, selling foreign assets and converting the proceeds into yen. This sudden demand could sharply appreciate the yen, reducing the value of foreign investments when converted back to yen. Risk assets worldwide, including emerging market debt, high-yield corporate bonds, and leveraged equities, could experience sharp declines. Even traditionally stable investments like U.S. Treasuries or European bonds could see volatility, and global credit conditions may tighten. A disorderly unwind can create stress in financial markets, making it harder for companies and governments to borrow and potentially affecting economic growth. A mixed or staggered scenario is also possible. Some investors may unwind quickly while others maintain positions, creating periods of fluctuation in capital flows and currency values. Markets would experience higher volatility, but no full-scale crisis. Credit would remain accessible, but at higher costs. Investors would demand more compensation for taking on risk, and global markets would slowly recalibrate to the new funding environment. Emerging market countries may adapt by adjusting fiscal or monetary policies, managing currency volatility, and moderating debt issuance. In this scenario, markets continue to function, but under tighter, more cautious conditions. For everyday people and investors, several key takeaways emerge. First, currency risk becomes more important. A stronger yen can reduce returns on investments held in foreign currencies. Second, credit risk increases. Borrowing costs may rise, and markets may experience more volatility, affecting mortgages, loans, and corporate borrowing. Third, correlation risk can increase, meaning that different asset types may move together during periods of stress, reducing the benefits of diversification. Fourth, structural shifts are occurring. The end of cheap yen financing may permanently alter how global capital flows, impacting emerging markets, leveraged investments, and funding for riskier assets. Even if you are not investing internationally, the unwind can affect everyday life. Global credit conditions influence the interest rates you pay for loans and mortgages. Volatility in markets can indirectly affect retirement funds, savings, and investments. Changes in currency values may influence import and export prices, which can affect inflation and the cost of everyday goods. Understanding these forces can help viewers make sense of broader economic trends without making financial decisions themselves. It is important to remember that this discussion focuses on structural changes, market dynamics, and potential implications rather than recommendations to buy or sell assets. The Japanese carry trade, which once provided low-cost funding for global investments, is undergoing a fundamental transformation. Rising yields in Japan, a stronger yen, and shifting capital flows are reshaping the landscape for global finance. The key point is that the era of ultra-low Japanese interest rates is ending. Whether the adjustment is gradual, disorderly, or mixed, global markets will need to adapt. Funding costs will increase, interest rate relationships will change, and risk will be repriced. Observing leading indicators such as bond yields, currency movements, central bank announcements, and capital flows can help individuals and investors understand the pace and scale of these changes. Even small shifts in these indicators can signal larger adjustments in global markets. Ultimately, the unwinding of the Japanese carry trade is not just a local issue for Japan, it has implications worldwide. Changes in funding conditions affect liquidity, investment strategies, borrowing costs, and financial stability across the globe. While the outcome is uncertain, the structural shift is clear. The cheap money era is ending, global capital flows are adjusting, and markets are entering a new phase of higher funding costs and increased volatility. Understanding this process is essential for anyone watching global financial trends, whether you are investors, savers, or simply interested in how international finance affects the world economy. By paying attention to key developments, individuals can better comprehend why global markets are behaving as they do, even without taking financial action themselves. The rise of Japanese bond yields, the potential strengthening of the yen, and the unwinding of previously profitable trades all highlight the interconnectedness of global finance. Recognizing these dynamics provides valuable insight into how capital flows, monetary policy, and risk perception shape the markets that affect everyday life and investments worldwide.